If you worked a single day after claiming Social Security, the government may have already taken money from your check and never told you. It's not a glitch. It's not a mistake. It's a penalty buried inside a law most retirees never see coming. And right now, there's a legal window to stop it. But that window closes August 1st. If you're watching this after that date, it may already be too late. Let me tell you exactly what this video is and who it is for. If you are between age 62 and 66, and you are collecting Social Security retirement benefits while also earning income from a job, a part-time business, freelance work, or any form of self-employment, the federal government is reducing your monthly Social Security check right now. Not someday, not as a future risk. Right now, every month, the Social Security Administration is calculating your earnings and withholding a portion of your benefit based on a rule that was written in 1983, and that the agency has never once explained clearly in plain English to the retirees it affects. August 1st is the date that matters for 2026. That is the point in the calendar year at which the Social Security Administration's mid-year earnings projections lock into a withholding pattern that is extremely difficult to reverse before the end of the year. If you are a working retiree and you do not act before August 1st, the penalty that has been quietly draining your check will continue through December and potentially carry into 2027. Let me walk you through exactly what this penalty is and how the Social Security Administration calculates it. The rule is called the Retirement Earnings Test. It is codified in Section 203 of the Social Security Act. And it works like this. If you are under your full retirement age, which for anyone born between 1943 and 1954 is age 66, and for anyone born in 1960 or later is age 67, and you are collecting Social Security retirement benefits while simultaneously earning wages or self-employment income, the Social Security Administration will reduce your monthly benefit based on how much you earn above a specific annual threshold. In 2026, that threshold is $22,320 per year. That is $1,960 per month. If you earn above that amount from work, the SSA withholds $1 in Social Security benefits for every $2 you earn above the limit. Let me give you the exact math so there is no ambiguity. Suppose you are 64 years old. You retired from your job as a teacher, a factory supervisor, a bank teller. It does not matter. You began collecting Social Security at 62 because you needed the income. Your monthly benefit is $1,900 per month. That is $21,600 per year. Now suppose you return to part-time work, consulting, retail, driving for a delivery service, anything that generates W-2 or self-employment income. Suppose you earn $38,000 per year from that work. That is $15,680 above the $22,320 annual threshold. The SSA withholds $1 for every $2 above the limit. So $15,680 divided by 2 equals $7,840 in withheld Social Security benefits for the year. Your $21,600 annual Social Security benefit is reduced to $13,660. You lose $7,840 every year, as long as you are under full retirement age and earning above the threshold. And here is the part that almost no retiree has been told. The SSA does not deduct that $7,840 evenly across the 12 months of the year. The agency withholds full monthly checks until the withholding amount is satisfied, which means instead of receiving a slightly smaller check every month, you receive no check at all for several months, and then your full check resumes for the rest of the year. For Dorothy, and I will tell you her full story in a moment, that meant 4 months with no Social Security payment at all. 4 months where she assumed her direct deposit was delayed, called the SSA twice, waited on hold for a total of 3 hours, and was told both times that her benefits had been adjusted based on her earnings report. She did not know what that meant. She had never been told the retirement earnings test existed. That is not an unusual story. That is the standard experience for the 1.3 million retirees currently subject to the retirement earnings test in the United States. Now let me tell you the second thing. Almost no working retiree knows about this rule. The money is not gone forever. When you reach full retirement age, the Social Security Administration recalculates your benefit and credits you for the months in which your benefit was withheld. Your monthly payment going forward is permanently increased to account for the withheld months. The SSA calls this the adjustment of reduction factor, which sounds reassuring until you do the math. A retiree who lost $7,140 per year for 3 years between age 62 and age 66, a total of $23,520 in withheld benefits, will receive a monthly credit of approximately $98 per month, starting at full retirement age. To break even on $23,520 in lost benefits at $98 per month of additional credit, that retiree would need to live to age 86. The average American woman reaches full retirement age at 67. She would need to live 19 more years to break even on benefits she already earned and already lost. That is the real cost of the retirement earnings test, not the monthly reduction, the lifetime math that nobody shows the retiree at the time the withholding begins. Let me walk you through exactly who this penalty applies to and who it does not. The retirement earnings test applies to you if you meet all 3 of the following conditions simultaneously. You are currently collecting Social Security retirement benefits. You are under your full retirement age, which is 66 for anyone born between 1943 and 1954, and 67 for anyone born in 1960 or later, with a sliding scale for birth years 1955 through 1959. And you are earning wages or net self-employment income above $22,220 in 2026. The test does not apply if you have already reached full retirement age. If you turn 66 or 67, depending on your birth year, the retirement earnings test disappears entirely. You can earn $500,000 per year from work, and your Social Security benefit will not be reduced by a single dollar. That rule is absolute, and it is the single most important fact that working retirees approaching full retirement age need to know. The test also does not apply to investment income, dividends, interest, capital gains, rental income, pension distributions, IRA withdrawals. None of that counts as earnings under the retirement earnings test. The SSA only counts wages reported on a W-2 and net profit from self-employment reported on Schedule SE. If your income comes entirely from investments and you have no W-2 income, the retirement earnings test does not touch you. There is also a special rule for the year you reach full retirement age. In that specific year, the calendar year in which your birthday puts you at full retirement age, the SSA uses a different and more lenient threshold. In 2026, that threshold is $59,520 for the months of the year before your full retirement age birthday, and the withholding rate drops from $1 for every $2 above the limit to $1 for every $3 above the limit. If you are turning your full retirement age in 2026, this distinction is worth thousands of dollars, and you need to confirm your exact situation with the SSA or a specialist immediately. The test applies to survivor benefits and spousal benefits under the same conditions. If you are a widow, a widower, or a spouse collecting on a partner's record, the retirement earnings test applies to your benefit on exactly the same terms as it applies to a retired worker's benefit. The income threshold is identical. The withholding formula is identical, and the recalculation at full retirement age applies in the same way. Self-employment income is calculated as net earnings, meaning your gross self-employment revenue minus your ordinary and necessary business expenses. A retiree who earns $38,000 in gross consulting revenue but has $16,000 in legitimate business expenses has net self-employment earnings of $22,000, just below the 2026 threshold, and would owe zero withholding under the retirement earnings test. That is not a loophole. That is the standard self-employment income calculation that applies throughout the entire tax code. Now let me walk you through exactly what August 1st means and why this specific date is the deadline that matters for working retirees in 2026. The Social Security Administration does not monitor your monthly earnings in real time. The agency cannot see your paycheck. They do not receive your W-2 until your employer files it after December 31st. They do not process self-employment income until your Schedule SE is filed with your tax return, typically in April of the following year. So how does the SSA know how much to withhold during the year? At the beginning of each calendar year, the SSA sends a notice, often called an Annual Earnings Questionnaire or an Earnings Estimate Request, asking beneficiaries who are under full retirement age to estimate their expected earnings for the year. Based on that estimate, the agency calculates the projected withholding amount and begins withholding monthly benefits accordingly. If you did not submit an earnings estimate at the beginning of 2026, or if your earnings have increased since you submitted that estimate, the SSA may be operating on an outdated or missing projection, which means the withholding pattern currently being applied to your check may not accurately reflect your actual situation. August 1st is the critical mid-year adjustment date for 3 specific reasons. First, it is the point at which the SSA's mid-year earnings review process is most active. The agency conducts internal reviews of benefit withholding patterns in July and August. A retiree who contacts the SSA before August 1st with a corrected earnings estimate, either higher or lower than the agency's current projection, is far more likely to have that adjustment reflected in the remaining months of 2026 than a retiree who contacts the agency in October or November. Second, August 1st leaves 5 full months, August through December, for the adjusted withholding to take effect. A corrected estimate submitted in August can change 5 months of benefit payments. A corrected estimate submitted in November changes only 2 months. The earlier you act, the more payments you can protect. Third, self-employed retirees who have had a slower than expected income year have until August 1st to recalibrate their projected net earnings and request a reduction in withholding that reflects their actual lower income. If your consulting practice earned $28,000 in the first half of the year but you expect the second half to be significantly slower, a revised annual projection submitted before August 1st can stop unnecessary withholding for the remaining 5 months of the year. The SSA processes mid-year earnings corrections through a simple phone call or written request to your local Social Security field office. You do not need an attorney. You do not need a financial advisor. You need your estimated annual earnings figure, your Social Security number, and a clear specific request to correct your annual earnings estimate on file. That call takes approximately 20 minutes. It can protect 5 months of Social Security payments, and almost no working retiree has been told it is an option. Let me tell you about Dorothy. Dorothy is 64 years old. She lives in Memphis, Tennessee. She worked for 31 years as a letter carrier and mail processing clerk for the United States Postal Service. She retired in 2023 at age 61, just before her 62nd birthday, with a modest federal pension of $1,240 per month and the ability to begin collecting Social Security retirement benefits at 62. Dorothy's monthly Social Security benefit at 62 was $1,520. Combined with her USPS pension, her total monthly income was $2,760. She owned her home outright. Her car was paid off. She described herself as comfortable, not wealthy but stable. In early 2024, Dorothy was offered a part-time position at a local department store. 3 days a week, 5 hours per shift, $17 per hour. The work kept her active. The income supplemented her retirement, and her annual earnings from the job were approximately $13,260 per year, well below the 2024 earnings threshold of $22,320. The retirement earnings test did not affect her at all. In January of 2025, Dorothy was promoted to assistant floor manager. Her hours increased. Her hourly rate increased to $21. By April of 2025, her annualized earnings had reached approximately $36,000 per year. She received no notification from the Social Security Administration. She received no letter explaining that she had crossed the earnings threshold. Her direct deposit continued normally through April. In May of 2025, her Social Security payment did not arrive. Dorothy called her bank. The bank confirmed no deposit had been received. Dorothy called the Social Security Administration. She waited 47 minutes on hold. When she reached an agent, she was told that her benefits had been suspended due to excess earnings. The agent explained the retirement earnings test briefly. Dorothy did not fully understand the explanation. She asked when her payments would resume. She was told when the projected withholding amount for the year has been satisfied. Dorothy's projected withholding for 2025 was $6,840. At $1,120 per month, the SSA withheld 4 full monthly payments, May, June, July, and August, totaling $6,080. The remaining $760 in projected withholding was deducted from her September payment, which arrived at $760 instead of $1,520. Dorothy spent the summer of 2025 draining her emergency savings to cover her property taxes, her Medicare supplement premium, her car insurance, and her groceries. She borrowed $1,800 from her son in July to cover a dental procedure she could not delay. She came to me in October of 2025 through a referral. We spent 2 hours together reviewing her situation. The first thing I told her was that the money was not gone, that when she reached full retirement age at 67, her monthly benefit would be permanently increased to account for the withheld months. The second thing I told her was that for 2026, she had options. If she reduced her hours or restructured her income to stay below $22,320, the withholding would not recur. Alternatively, if she tracked her actual earnings through mid-year and submitted a corrected projection before August 1st, she could protect the second half of 2026 even if the first half had triggered withholding. Dorothy chose to reduce her hours voluntarily. She negotiated a schedule that kept her 2026 earnings at $21,800, $520 below the threshold. The retirement earnings test does not apply to her this year. Her full $1,120 monthly benefit arrives every month without interruption. Dorothy lost $8,400 in benefits in 2025. She will recover approximately $35 per month, starting at age 67 as the recalculation credit. Her break-even age for that recovery is 86. She is currently 64. She did not have to lose that money. The rule existed before she took the promotion. The threshold was public information. The mid-year correction process was available. Nobody told her any of it. Let me walk you through the 4 most common mistakes working retirees make when dealing with the retirement earnings test, because awareness of the rule is not the same as navigating it correctly. Mistake number 1: assuming the SSA will notify you before the withholding begins. The Social Security Administration does not send a warning letter before it suspends your payment. The agency's process is to withhold first and notify afterward, typically through a notice that arrives weeks after the payment has already been missed. By the time most retirees realize something has changed, 1 or 2 full monthly checks have already been withheld. If you are under full retirement age and earning above the threshold, you need to be proactive. The SSA will not proactively warn you. Mistake number 2: stopping work entirely to avoid the penalty rather than restructuring earnings strategically. Many working retirees, when they learn about the retirement earnings test, immediately assume the only solution is to stop working. That is almost never true. The threshold is $22,320. A retiree earning $28,000 can often reduce to $22,000 through a modest reduction in hours, eliminating the withholding entirely, without sacrificing the employment, the health benefits, or the social engagement the work provides. Stopping entirely is the nuclear option. Restructuring is the intelligent option. Mistake number 3: not accounting for self-employment expenses. Self-employed retirees, consultants, freelancers, part-time business owners, frequently calculate their earnings test exposure based on gross revenue rather than net profit. The SSA uses net self-employment income for the earnings test, the same figure reported on Schedule SE. Legitimate business expenses reduce that figure directly. A retiree who earns $32,000 in gross consulting revenue and spends $10,000 on legitimate business expenses has net SE income of $22,000, below the threshold. Failing to account for those expenses could lead a retiree to unnecessarily reduce their business activity or stop working entirely. Mistake number 4. Missing the mid-year correction window. Retirees who experience a significant income change mid-year, a job loss, a reduction in hours, a business slowdown, often do not know that they can contact the SSA to update their earnings estimate and reduce their projected withholding for the remaining months of the year. That correction must be made proactively. The SSA will not reach out to you when your income drops. You must call them, and you must do it before the end of the adjustment window, which for 2026 is August 1st. Here are the 5 protection moves every working retiree needs to take before August 1st to legally keep their full check. Protection move number 1. Calculate your 2026 earnings exposure today. Add up your actual earnings from January 1st through the end of last month. Multiply by 12 and divide by the number of months elapsed to project your annual total. Compare that projection to the $22,320 annual threshold. If you are on track to exceed the threshold, calculate the projected withholding using the formula projected earnings minus $22,320 divided by 2. That is the amount the SSA will withhold from your checks this year. Knowing the number is the first step to acting on it.